Overnight, the market executed a massive upward surge, tearing through resistance with aggressive, sustained buying pressure. This chart shows the Dow Jones Industrial Average on a 1-hour time frame. Look at the right edge. The move is almost entirely vertical, creating an immense gap from the previous session's close. And this isn't isolated. This chart of the NASDAQ 100 shows the tech sector executing the exact same pattern, a severe upward gap followed by a steep, unbroken trajectory. Before we dissect this setup, please note, this video is a structural breakdown of market mechanics. It is not financial advice, and you must manage your own risk. Here is the problem. This severe technical extension is happening just hours before some of the most critical macroeconomic data of the month is released. To understand what happens next, we have to look at three things: the structural integrity of price action, the internal breadth of the market, and the economic calendar. Only by cross-referencing all three can we build a rigorous, data-driven hypothesis for the August 5th session. We start with the granular, 1-hour price action to test the foundation of this rally. This chart shows the S&P 500 hourly index. The angle of attack on these recent green candles is incredibly steep, leaving massive vertical air gaps. But looking at the volume histogram below, there is no corresponding surge in participation to support this velocity. To see if this structural weakness is market-wide, we need to check the tech-heavy indices. On the NASDAQ 100, we see the same steep trend line and massive final gap. But pay close attention to the last candlestick at the absolute peak. That small red doji, following a massive climb, signals a sharp equilibrium between buyers and sellers. This specific formation is a textbook technical indicator of pre-market exhaustion. It tells us that early institutional buyers are actively taking profits, and new buyers are hesitating to step in at these extreme highs. While the overarching trend looks aggressively bullish on the surface, the terminal data points prove the immediate momentum is already stalling out. If momentum is stalling, we have to look past raw price and examine internal market breadth. We need to know who is actually buying to push the indices this high. This image shows a broad market heat map, our primary diagnostic tool. The buying pressure is heavily concentrated. The bright green blocks, specifically NVIDIA, Broadcom, and Micron, show that the foundation of this move is incredibly narrow. The semiconductor subsector is doing almost all the heavy lifting, effectively masking the reality of what the rest of the market is doing. To see that reality, look at the consumer cyclical area. We see distinct red blocks, highlighted by Amazon sitting firmly in negative territory. That mixed performance bleeds into other fundamental economic pillars as well, with healthcare and energy showing distinct weakness. Weakness in major consumer equities like Amazon is a significant red flag. It points directly to underlying concerns about overall consumer spending power. Structurally, a market-wide rally built entirely on semiconductor demand functions like a table with a single leg. This severe concentration makes the entire index highly vulnerable. If the tech sector falters even slightly, there is no broad support to safely catch the fall, risking a rapid unwinding of the indices. The internal mechanics reveal a hollow foundation that directly contradicts the bullish story told by the surface-level price charts. This fragile setup is about to be violently tested by a severe external macro threat looming on the calendar. This image displays the economic calendar, specifically highlighting Wednesday, August 5th. The first major hurdle of the day is the ADP non-farm employment change. This data measures private payrolls. With the broader economy showing signs of friction, institutional capital is hyper-focused on this print to prove whether the labor market is actually resilient. Shortly after, the market faces its second hurdle, the ISM Services PMI. The ISM data dictates the health of the services sector, which acts as the primary growth engine for the entire U.S. economy. We call this setup a binary event. The aggressive overnight price action means the market is already pricing in a perfect economic outcome, leaving absolute zero margin for error. This creates severe asymmetric risk. If either the labor or services data prints lower than expected, the optimistic premium holding these charts up will instantly evaporate. Together, these two data points possess the power to flip the dominant market narrative from aggressive speculative buying straight into recessionary fear. Combining technical exhaustion, neuro breadth, and macro catalysts provides a clear predictive model. Path A is the low probability scenario, a grinding continuation upward requiring absolutely flawless ADP and ISM data. Path B is the high probability scenario, a sharp downward vector, triggered the moment either report fails perfection. If that downward path triggers, institutional algorithmic sell-offs will immediately target the massive technical air gaps left behind during the overnight run-up. The structural alignment of all these factors heavily favors a violent mean reversion event, which makes opening new long positions at these current levels mathematically poor trades. Expect extreme erratic price action immediately at the market open as algorithms attempt to digest both the ADP and ISM data simultaneously. There will likely be a strong bias toward intraday profit-taking as early buyers rush to secure whatever gains they have from the fragile overnight gap. It all comes down to the risk-to-reward ratio. The current technical setup offers terrible upside potential when weighed against the massive downside exposure sitting right below it. A professional trader reacts strictly to the underlying data structure, completely ignoring the emotional pull of those massive green candles. This analysis is strictly educational. Surviving a highly volatile session like August 5th demands strict independent risk management.